Hello, Sean. Welcome to our 0100 DACH speakers interview. We're really happy to have you here with us, and we are going to be discussing constructing an institutional quality venture portfolio. You actually did a panel on the topic, right?
Yeah, that's right.
How was the panel?
Yeah, the panel was a lot of fun. I think it's always sort of good when you don't agree on everything.
Great. So I'm glad to hear that. I'm sure it was interesting for the audience. So let's go into a bit of detail on the topic also for our viewers. From your perspective, what defines an institutional quality venture fund-to-fund program today in terms of repeatable alpha, liquidity management, diversification, and operational scalability?
Yeah, there's a lot to unpack in that one. But really, I think you've got to go back to basics of venture capital. Only a small number of companies create the vast majority of the value. It tends to be the top 1% of exits generating the majority of exit value, in fact, over a pretty long period of time. So you need to sort of think about how do you get access to those underlying companies that are creating all the value. So the way we do it on the primary side is we think if you back the best blue chip managers globally, and you do it in a concentrated way, those managers are the ones with demonstrated ability to repeatedly work with the very best founders. And this means that they're backing the best founders across different sectors, across different geography, across different stages very often. But that's what really drives the performance for us at the portfolio level. So again, taking a really straightforward view, are you getting access to the very best companies? And because those are the ones that will drive performance. I think then we sort of do look at things like, what's the breakdown in terms of sector, stage, and geography, but we do it almost as a post hoc thing to sort of see if we're on the right track. So we end up, in our current program with about 70% of our capital going to the US and about 10% each to Europe, China, and India. But it's all done on a bottoms up basis because we are selecting those managers first. We sort of monitor that to make sure we think that looks sensible, managing it from a risk perspective, especially in geographies like China, for instance. But then again, you're not doing it the other way around. Now, we used to do it that way. We made those mistakes in the past where you're saying, look, we want to allocate a certain percentage to, say, Europe. Let's go and find managers to fit in that bucket. Or people might be doing it today with AI and they say, look, we want to have exposure to AI. Let's find some AI-focused managers and let's go and fill up that bucket. That tends to be the wrong way to do it because, again, LPs, we tend not to be best placed to make those sort of tactical decisions.
But I assume the environment is very competitive and everybody wants to get to those best performing ones, right? So, and you've invested in ventures since 1997. So what differentiates genuine top-tier access in primaries from perceived access in today's competitive environment?
I think you're exactly right. It is very competitive and our strategy is very easy to describe. I think it's very hard to execute, especially in a meaningful way in terms of that access. So for us, having top tier access, it doesn't mean you get into all the funds you want to, or you get the desired allocation in all the funds. Like that will never happen. But it means that you can construct a portfolio where you don't feel constrained. You feel you don't have to make compromises, and you don't feel you have to say, look, we need to add some tier 2 managers or some people we don't have real conviction in because we need to make up the numbers. I think that's really, really important. And the way we get around that is that we size our funds based on the investment capacity. So we say, look, we think we can invest $300 to $400 million with our current group of managers. We think we've got a very high conviction in that, and we think that sort of matches what our access is like. So that's how much we'll raise. It's not a case of saying, look, let's go and raise $1 billion because that'll be good for the business. It might be easier to raise. You can speak to bigger allocators, but then you've got a challenge of, well, where do we find that other 600 million to deploy? And that's where you get to sort of bad incentives. So for us, again, not having to make compromises on manager quality and being able to be in that position because we've been sensible around our fund sizing.
Okay, and actually based on what I know about you, you focus on backing leading unicorn hunters. How do you balance manager concentration with the diversification required by institutional allocators?
Yeah, so I'd almost push back on the unicorn hunters a little bit because what I find is, our managers today are not looking for billion-dollar companies. They're looking for companies that can return $1 billion plus from a single investment. This sort of means that you're backing companies that are worth, 10 billion or more. And if you look at the most valuable companies on the market in the private markets today, SpaceX is over $1 trillion. You've got OpenAI and Anthropic over 100, and also non-AI companies, or at least non-model companies like Stripe or Databricks, also now north of $100 billion. So the goalposts have changed. Venture and the companies have become much bigger than bigger than I ever thought they would end up being. So again, it is a case of like, the bar has been raised. For us, I think diversification, it is important, but as long as it's not naive diversification. And what I mean by that is if you've got access to a handful of managers and you say, look, I need to add 3 or 4 new names to increase my diversification levels, that's probably a mistake. So really for us, we say, look, if they meet our criteria, and it's a pretty stringent criteria, we want to invest there. We don't want to say we need to have a certain number of managers or a certain number of funds or a certain number of underlying portfolio companies, because if you add in stuff that doesn't really meet your bar, then it's a really easy way to destroy value in venture. And again, we know this because if you go back 25 years, we used to have 30 managers. That was a very diversified portfolio and the performance was worse for it.
And before this little interview, we actually, and also speaking of diversification, we were speaking about your focus on the secondaries at the moment. So how do secondaries complement your primary program? Are they mostly a liquidity tool for you, or a way to enhance DPI, or a way to access managers you might not otherwise reach?
Yeah, so secondaries, I think, becoming an increasingly large part, or at least a normalized part of the venture fund investing landscape. And when we say secondaries, we're generally talking about buying fund stakes in existing funds or some GP-led transactions where they're restructuring mature vehicles. For us, it is a way to get earlier liquidity. So if we buy a fund that's 8 years old, as an example, they might have some assets in there that are already public and are distributing or much closer to their eventual exit. So you get much quicker liquidity from those sort of investments compared to early stage or even later stage venture. In our flagship primary program, we're about 20% secondaries, about 40% later stage venture, and 40% early stage. So we're really balancing the liquidity you get in the early and I guess medium stage from venture growth, along with the long hold times that you need for early stage venture. It takes over 10 years for the best startups to go from founding to being public. So you need to be able to make sure you've got some interim distributions built in structurally, otherwise you'll be wasting a long time for that capital to come back. For us on secondaries, it really is also, as well as the liquidity point, the other sort of under-discussed point is that it's a way for us to double down on the very best companies. So, we think that value creation in venture is all about accessing the top 1%. It's a real focus on quality. And if you look at some of the recent secondary deals we've closed, it's given us more exposure to companies like a SpaceX, like a Rippling, like a Databricks. So for us, just being able to get more of our clients' dollars into those very best companies is just a really attractive thing for us in terms of our portfolio construction.
Right. But still in periods of exit slowdown, right? We're currently navigating the liquidity squeeze period and denominator pressure. How do you actively manage capital calls, distributions, and portfolio exposure across both primaries and secondaries?
Yeah, so we're in quite a nice place in terms of we've got discrete pools of capital as a fund of fund. So if we raise a vehicle every 3 years, it's not a case that we have to rebalance across the different vintages, if that makes sense, the same way an endowment or a foundation or a pension fund would. So that means that operationally that's a little bit easier for us. Again, another thing I push back on is the lack of liquidity. It's very true at an industry level, but if we look at our portfolio last year, we had really good liquidity. We had the acquisition or the semi-acquisition of Scale AI by Meta. We had the announced acquisition of Wiz by Google, which was about 32 billion, will be the largest venture-backed M&A in history. So fingers crossed that closes soon as it passes through antitrust. And also IPOs from the likes of Navan and Netscope and Circle and Figma. So, we've really sort of seen that liquidity actually has been pretty good. But then again, it's venture's all about the power law. So if you were in those small number of funds that had concentrated exposure to those companies, you'd have done very well on the liquidity side. If you didn't, then it's really, really tough out there. And then the other sort of thing we think about with our mature funds is sort of balancing really what our investors want. Because, some of our more mature vehicles will have, really high quality assets remaining, but they might be getting very long compared to what people thought the initial investment term would be. So one of our mature funds, the remaining value drivers are Stripe, Databricks, Xiaohongshu, Figma. Those are all world-class assets that's worth holding on to. So we want to have that dialogue with our investors to make sure if they need liquidity at this point, that we can provide it in a sensible way. Or if they're happy to hold and they don't need that liquidity, then we're not sort of shortchanging them in terms of that increased or the continuing compounding, which we sort of see happening in the underlying portfolio.
Interesting. So given that most venture returns come from a small number of early stage outliers, how do you ensure sufficient exposure to early stage convexity while maintaining portfolio level liquidity discipline?
I think, you do see the outlier deals that everyone talks about, the 100x, the 1000x deals at the early stage. But I think what's misunderstood by some people is the level of convexity you get at the later stage also. And there's two components to that. One is that these companies are just getting much bigger than we ever anticipated. So again, being over $100 billion company is now, it's not quite a routine thing, but it's not a crazy thing that you've never heard of before. The fact that we've got $1 trillion company in the private markets now, again, that's very much the exception, not the rule. But if someone says, look, we think this is $1 trillion opportunity, you can say that with a straight face. So backing these companies, even if they're worth $1 billion or $10 billion, maybe even $100 billion, you can still say there could be a venture style outcome from here where you're thinking generally 3 to 5x with potentially 10x or 10x plus upside. The other bit that's important to understand about venture growth is that there's increased concentration in terms of the amount of investments a fund is making. Managers that run that high conviction strategy will put around 10% of the fund in their highest conviction bet. That would be extremely aggressive at the early stage. I mean, so some folks may do it, but it means that you're sort of, in a way, if you think about it, like this is a bit of an oversimplification, but if you think about investment being less risky as it matures, you're making sure you're getting sufficient risk by increasing the concentration in your own portfolio construction. So if you get a 10x on a growth stage deal, if that was 10% of your fund, that's a fund returner. Again, whereas at the early stage, a 10x deal generally won't mean you get there, but it's just a different way where you do get that convexity from the later stage. And that's really important for us, because if we were saying we're getting good real early liquidity from venture growth, but the multiples are disappointing, that's probably not a great trade.
Right. And how central is re-up strategy in your portfolio construction? And under what circumstances do you choose not to continue with a previously backed GP?
So our manager roster is fairly concentrated. So it's about 12 names globally. And what that means is we've got a very high degree of re-ups because everyone's a high conviction bet in our portfolio. It is actively managed, and we do tend to have roughly one new name and one falling away every 3-year fund cycle, but it's not a hard and fast rule. If we thought the best thing for our portfolio would be to add 2 managers and keep everyone and go up to 14 names, that's great. If we thought, actually, no, there's no one else we want to add and we think 2 people are falling away, let's go down to 10, not a problem at all. We run a full diligence process for every individual fund that we invest in. So we try and, we do look at these things rigorously. And at the same time, we sort of spend a lot of time with our managers. So we try and identify and address any issues as they pop up, not when it comes time for a full diligence process. So again, we expect our portfolio to look fairly similar in 5 years' time, but we're always looking to tweak it around the edges, especially where we think there's a chance to access an extremely talented manager.
And now a question about the AI, because everybody's talking about AI, obviously. With a surge in AI-dedicated funds, how do you assess specialist AI managers versus generalists incorporating AI in their thesis?
Yeah, so full disclosure, there's no AI specialist managers in our portfolio. Again, for us, it's all about, can you access those very best companies? And if we look at what our generalist managers, or what we like to call internally now serial specialists, because that's really what they are, you'll see access to the first venture round of OpenAI and Anthropic. You'll see early stage access to companies like Cursor, like Abridge, like Glean, like Open Evidence. And these are sort of really some of the hottest companies, globally in the AI space. And the important thing for us is that we didn't make a decision that we need to go into AI. We're not making that decision today. We didn't make that decision 5-6 years ago when our managers did. And it means that we sort of stay on the front foot. Because if we said we need to make those sector bets, we need to make them early and we need to make them correct. And we just don't think there's a way for an LP to really do that. So again, if you're a fund manager and you're consistently partnering with the companies that really matter, then excellent. We want to hear from you. But we sort of typically find that it's the world's very best managers, in a generalist sense, that the best founders want to work with. So again, it's a little bit of not quite the same right answer to the question, but that's really how we've been playing it.
Okay. After committing over $3 billion across multiple cycles, what structural adjustments are necessary today to build a venture fund's portfolio that can deliver both top quartile growth and controlled liquidity over the next 10 to 5 years?
I'll sound like a broken record, but it really is all about consistently backing the very best, backing managers that can consistently back the very best founders. Venture is a really, really simple game when you come down to it. The problem is it's just so devilishly hard to execute. So for us, again, if you're backing the right companies, whether it's at the seed, Series A, the pre-IPO round via secondaries, you're generally going to be in a really good place. And the nice thing is you get this really strong persistence and performance effect, across vintages for the very best managers. Again, we're increasingly seeing it becoming more of a global game, not just in case of where we're, in choosing to invest in the US and in Asia and in Europe, but where the best founders are choosing to work with the best VCs. doesn't really matter where either of them are based. So we've seen quite a lot actually of, top companies from Europe partnering with US managers, and not necessarily the US managers that have local offices, but just because our managers are looking for the very best global companies, period. And the companies are doing the same in terms of VCs, in terms of who they're looking to work with. So again, focusing on quality, I think that will put you in good stead over the long term in this asset class.
Great. So we've come to full circle,
Yep.
right? We return to the very first question, actually. So it's all about the quality of the managers.
Absolutely.
Yeah. Thank you so much for doing this interview with us. I hope you're enjoying Vienna, and thank you.
That's been a lot of fun. Thanks for having me.
Thank you.